Hey everyone, welcome back to Corporate Decoder, the place where we decode the complex world of business and finance. Today we're diving into SKECHERS USA Inc. and trust me when I say this report is a bit of a game changer, or perhaps more accurately, a game complete. We're going to uncover what really happened behind the scenes when this athletic footwear giant was acquired. If you like getting straight answers from corporate filings without the jargon, make sure you're subscribed and join our Discord community linked in the description below for even more insights. Alright, so SKECHERS USA Inc. has officially been bought out by a company called Beach Acquisition Co-Parent LLC, which is backed by investment funds managed by 3G Capital Partners. This isn't just a simple change of hands, it's a full-blown merger. The deal closed on September 12, 2025, and it means SKECHERS is no longer a publicly traded company on the New York Stock Exchange. They've basically gone private. This document, a Form 8K, is like the official announcement that a major event has happened. And the big event here is the completion of this merger. Think of it as the final curtain call for SKECHERS as a public entity. Now let's talk about what this means for the people who owned a piece of SKECHERS. This report details how existing company stock and stock awards were handled. If you held regular shares of SKECHERS stock that weren't part of any special agreements, each share was converted into either cash or a mix of cash and something called a parent unit. For those who chose the all-cash option, they got $63 for each share they owned. But if they opted for the mixed deal, they received $57 in cash plus one of these parent units. These parent units are essentially like a piece of the new parent company, but they aren't traded on any stock exchange. For employees holding stock options or awards, those were handled too, basic stock awards that were just based on staying with the company. Those all vested immediately and were converted into cash, again $63 per share. But for stock awards tied to performance, things got a little more complicated. Instead of cash, these were swapped for what are called Class P units in the new parent company. These units are still subject to some of the original conditions like staying with the company, but the performance part is handled differently. It's crucial to understand that these parent units aren't publicly traded. The goal is to take them off the official records even faster. This means for anyone who received these as part of the deal, they're not going to be able to easily sell them on an open market. It's a move that strongly signals a private company structure. To fund this massive acquisition, the new parent company, Beach Acquisition Bidco LLC, had planned to raise a lot of money through debt. They essentially had indentures for senior secured notes and senior Piquet toggle notes. Picture this as getting loans from various investors before the deal officially closes. The money from these loans, about 1 billion euros and $2.2 billion, was held in special accounts called escrow accounts. On the closing date, September 12, 2025, all the conditions were met. That money was released and used to help pay for the merger expenses. On top of the debt from the notes, the new structure also involves a significant credit agreement. This agreement sets up a couple of major loan facilities. There's a term loan facility worth approximately $3 billion in US dollar equivalent and a revolving credit facility for $1.6 billion. These are the main loans that will now be on SKECHERS books as part of its new ownership. This is a really definitive piece of the puzzle. As soon as the merger was finalized, SKECHERS officially told the New York Stock Exchange that it was done trading there. They asked for their stock to be removed from the exchange. This means if you were a public investor holding SKECHERS stock hoping to see it on the NYSE, that chapter is now closed. The company is no longer listed and will soon be filing paperwork to stop its public reporting obligations. It's also important to note that some major shareholders, particularly those connected to the Greenberg family and the SKECHERS Voting Trust, had agreements in place to support this deal. These weren't minor players. They agreed to accept the mixed consideration, meaning they took some cash and those parent units we talked about. This support likely smoothed the path for shareholders' votes needed to approve the merger. And what about the leadership? As expected in a buyout like this, there's been a shake-up. Some of the existing directors have resigned. The directors from the acquiring company's merger subsidiary are now the directors of the company. The officers, the day-to-day managers, they've mostly stayed on. Importantly, the report states these director resignations weren't due to any disagreements with the company or its management. Now, looking at this whole situation with SKECHERS, the takeover by 3G Capital Partners marks a significant transition. The price of $63 per share offered in cash was a premium over its recent trading price, which is typical in these deals. However, the inclusion of these parent units for those who chose the mixed option means their final payout and the ongoing value they hold are tied directly to the performance of privately held entities, governed by agreements we've only seen snippets of. This transition to private ownership and the significant debt financing around over $4.6 billion in the described notes and credit facilities shows a strong commitment from the new owners to control the company's direction and finances without the constant scrutiny of public markets. For investors who held Skechers stock, this filing confirms the end of their public investment journey. For the company itself, being private offers flexibility. They can now make long-term decisions without short-term quarterly earnings pressure. However, they also face the challenge of managing substantial debt obligations and growing the business in a competitive market, all while keeping their stakeholders happy without the transparency of public filings. The success of this acquisition will hinge on 3G Capital's ability to drive growth and manage that debt effectively. It's a bold move into private equity for a well-known brand. Alright, that's our breakdown of Skechers' latest filing. What's your take on this acquisition and what it means for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into corporate finance. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.